Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, May 8th, 2022. Happy Mother's Day to all the moms out there, especially happy Mother's Day to my mom. Mom, happy Mother's Day. We've got another great show for you this week. We've got members of the media, academia, and financial services standing by as we analyze all the news and events for the week. So sit back, relax, enjoy this episode of BRN Sunday. Welcome back. We'll kick off the show, I should say, on this beautiful Mother's Day with a look at what's happening in consumer products, technology, finance. You never know what we're going to cover on the network in this particular segment. Joining me now to discuss this and a whole lot more, Daniel Klein is the managing editor for TheStreet.com. Dan, great to talk to you. Thanks so much for joining us this morning.
Good morning, Jeff. Thank you for having me.
All right, so it's been a whirlwind of travel for you, Dan, and I think before we talk about streaming and managing all this voluminous amounts of streaming content, let's talk about, you actually went to the Oracle of Omaha. You went to Fuletta, Omaha for Berkshire Hathaway meeting. What was that like? I know it was, I think you said 2 years in the making, so tell us a little about what you saw and what you heard.
It's very celebratory, but it was also, revelatory that I think more companies should do this. It was basically, the idea that Berkshire Hathaway doesn't give analysts, doesn't give insiders its information before it gives it to its shareholders. And basically, the meeting kicks off with sort of a funny film that they only show once because it has a lot of celebrity cameos. And then it's really just Charlie Munger and Warren Buffett answering questions and telling you how the company's doing. And, I'm not going to belabor it, but more companies should do this. There is also, of course, an entire exhibit hall where you can get inexpensive See's candy and Dairy Queen, and I bought some Brooks sneakers. So it was a lot of fun, but it's also, I think, a blueprint for how more companies should be doing things.
Dan, give us the picture here. How many people are we talking about in attendance? Is it 10,000, a million, 100,000? What's the gamut here?
So between those two numbers, in a normal year,
that was original, right?
In a normal year, it's about 40,000. I don't think there were quite that many this year, but it takes place in an arena, and the arena is full, and then there's a lot of people in the exhibit hall. So it fills the city of Omaha. It becomes very hard to get in and out of what is a relatively small city. But here, I'll share a little tip. Omaha borders Iowa, and people don't realize that. So the hotels and casinos in Iowa are much less expensive. So I could actually see the venue from our hotel rooms, but was not paying. In fact, I was comped at the Harris Casino. So a fun weekend, and then I flew to New York. So, Jeff, this is my first time home in more than a week.
Well, I'm sure your family is, or maybe they're not happy to see you, but I would think they're happy to see you. I'm glad you're back for Mother's Day. Dan, let's get to the topic at hand, which you and I talk about a lot of technology things, but let's talk about streaming again. And there's this problem that exists in the streaming world of having to create and overcreate content. And I know they're not really our friends, but I'm going to say our friends at Amazon are trying to figure out a way to solve this endless streaming content problem.
So they have an interesting solution. The problem is what their content base is that they're applying it to. So Amazon owns IMDb, Internet Movie Database, which has a free streaming service, which has a bunch of, movies and television shows. Nothing great because it's free. And they've sort of gamified content selection. So you can answer some questions, you can play some games, and in theory, it helps you find what you might want to watch. That's a great idea if you could apply it to all the content you have. Because, Jeff, I just got on a plane. I spent a lot of time in the past few days on planes. And if I could have logged in to something that said, okay, these are all the shows Dan could watch, let's answer some questions and narrow down what he wants to watch, that would be very useful. The problem is they're only doing it across the IMDb platform of content, which is kind of like deciding which movie from 1987 you want to watch, or, are you into Manimal reruns, or, give me a break. Like it's generally not the best suite of content, but it is a very good idea.
Yeah, let's not knock Nell Carter. I used to love and Joey Lawrence. I used to love Give Me a Break. Dan, Amazon, in my mind, people sign up for Amazon Prime not for the videos. They sign up for get free shipping and access to retail and products, etc. At least that's my opinion. Um, but they recently purchased MGM. Is this part of a larger play to compete with Netflix and HBO Max and Discovery and some of the other networks that have launched?
It, it's a larger play to make Amazon Prime Video feel valuable to you if you move into having less things delivered. And it's not like people are ordering less, but remember when we used to get books and CDs? There's just a lot of things that have moved to digital. So the
Hmm.
whole point of Amazon Prime, the video, is so you keep that connection, even if you do order slightly less things, simply because maybe you're getting them same day delivery from Walmart or Target. Maybe you're not getting them because you're consuming that a digital way. So it's a lot of just sort of a hedge. So I don't think they're looking at making this a Netflix equal. I think they kind of want there to always be something you want to watch on the platform.
And let's just talk about streaming. And is the play here? So we have seen a decline in subscriptions for Netflix, right? Because how many people over after X many number of years, those people, everyone has a Netflix account pretty much who's going to have one. So is the model going to shift to advertising based? And is that what Prime through IMDb, Amazon through IMDb, and maybe through future acquisitions will look to do? I use another streaming platform called Tubi. I don't know how you pronounce it, but that is strictly, is it Tubi?
It is.
Okay, but that is for me ad based. So I watch an ad every, I don't know, 10 minutes or so. It's not that bad. It's three ads, maybe a minute, 20 seconds. But what's the future look like? Is everyone's kind of struggling to create content, also monetize this stuff because there's only so many subscriptions that you and I need.
So it's going to be a mix. And I think we've overplayed the Netflix loss of subscribers. If you subtract out the people they cut off in Russia, they actually had a slight gain in subscribers. I don't think they pulled a lot of subscriptions ahead due to the pandemic. I don't think this is a big negative story. But yeah, I think ad support is going to matter, but it has to become a better experience. I'll give you an example. I was traveling and I watched The Flash on CW, and CW has a free streaming service that's ad supported. Well, fabulous. Well, here's the problem. Every commercial break, they showed me the same Carvana commercial 4 times. That is not effective for Carvana, a company I very much like, that I purchased 3 cars from, that I now have a negative connotation with because they showed me 4 ads every time, and it was the same ad. So they really have to figure out how to make the ads closer to content. Where I'm seeing an ad for something I want that's really tied to what I'm watching, it has to become a better experience. When you flip through Facebook and you get an ad for a local restaurant that you didn't know about, and you then decide to go there, was that an ad or was it content? And that's really where this world has to move to. And I think we're absolutely in the infancy when we're still getting these sort of terrible experiences where we're seeing, the same Geico ad 15 times or the same, in my case, Carvana ad. But it will matter. It will be part of it. But I wouldn't count out subscriptions. I think, are we going to always pay for Disney Plus? Yeah, like Obi-Wan is coming. Like there's always going to be a show we really want. So I think these things are happening, they're coming, and it's going to be an evolution as, we sort of see the end of the traditional cable model.
Dan, you mentioned you seen the Carvana ad, maybe I see the Geico ad, someone else sees I don't know, think of anything, some other ad. Where does this kind of, obviously they're reading something, cookies, your viewing history on your site. Where does this kind of balance up against privacy and intrusion?
So right now, I actually think for most of these companies, it's not all that sophisticated.
Yeah.
I People who watch The Flash might buy a car. I don't think it's even specifically. There's no login on the CW app, so it's not like they know that much about me. And honestly, I want targeted ads, and I know people get mad about that, but like it's Mother's Day on Sunday, and don't tell my wife, but as of Friday, I hadn't purchased a gift. So if they start giving me good gift ideas because they intrusively knew I hadn't bought one yet, that to me is content. And I know not everyone feels that way, but I want well-targeted ads that are beneficial to me. If I'm my wife and I just bought a house and we're redoing a lot of things. And if you show me ads for, I don't know, paint samples or quartz countertops or whatever it might be, that's kind of where my world is right now. So that's content, not just showing me the same, Flow from Progressive or Limu Emu ad, 100 times over, which is really kind of what they're doing right now.
Yeah, well, I do agree. From my experience as a streamer building a television network, I don't think the algorithms are exact. I think that there's a lot of data that people don't have. It might be a bit intrusive to get it. I think we're still a ways away. Dan, well, I really appreciate you. Look, we had a great conversation. I think we talked a little bit about Berkshire. And then we moved to streaming, and I hope you find that gift that you're looking for your wife, at least before she listens to this program, because I'm sure she's a big listener, at least of your segment. I want to wish you a great Mother's Day and a great rest of the weekend. We'll talk to you again next week, my friend.
I'll talk to you next week. Thank you, Jeff. See you, bye.
Welcome back. Now we're going to shift gears, talk about what may or may not be happening on Capitol Hill. Litigation, legislation, regulation. Joining me on the line, you know him as the Legal Eagles. You also know him as David Levine, Kevin Walsh. Both are principals for Groom Law Group, an employee benefits law firm based in Washington, D.C. And I do have to say that they are two of the most likable guys in the retirement industry, at least from my perspective. I know from so many others. Guys, how are you this morning?
So Jeff, thanks for saying that. I hope our listeners are having a brighter weekend than we are here in DC. And your comment there really brightened our weekend a little bit. And I think I'm going to throw it to David here to talk a little bit about things that have been darkening the mood for those who offer brokerage windows.
And on a Mother's Day, David.
Oh, happy Mother's Day, everyone! I'm sorry, I need to say that as well.
Yes, and most importantly, happy Mother's Day. And for those hearing the nasally voice, this is one eagle who's been grounded in the nest getting better. But we're going to talk this week, not necessarily about darkening of mood, but I'll say a real debate coming to the head. For those listeners who've been with us, and Jeff, you've certainly heard us go on and on. Kevin and I always joke about missing participants. What's going on with missing participants? What's going on? Why is the DOL doing this? What's the basis? All this. And then you heard us switch to cybersecurity. And recently you've heard us talk about crypto, but really bigger discussion is brokerage windows. But we're sort of having something come to a head right now. In the past week, you have members of Congress coming out basically and saying, Department of Labor, why are you coming out with this guidance? Well, I won't even say guidance. Why are you coming out with things on the website where you post things without all that Administrative Procedures Act stuff that we've talked to all y'all about in the past? And shutting down crypto, saying there's more duties in brokerage windows. And Senator Tuberville comes out with an op-ed on this the other day saying, what are you doing here? Dovetail that with trade groups that deal with the Department of Labor very regularly, have all been sending in comments saying, why are you suddenly saying there's more duties in a brokerage window? And it really brings to the fore something that is a big issue that goes way beyond benefits. How does the administrative state work? And this sounds so dark and gloomy. Because what we're seeing...
Oh, no. Abstract problems.
I'm not going super abstract. Because really the question is, you need regulators to tell you how things work, but there's rules about how they formally are supposed to tell you. But there's lots of practices that have developed over time. And you are seeing major pushback across the retirement industry about the DOL basically saying on its website in a compliance assistant bulletin and posts that the idea that a brokerage window, there could be additional duties to monitor inside, but only if it's cryptocurrency or not. There's lots of different statements about this. So where we are today is we're finally hitting that wall where a lot of people have sort of said, this is the hill we want to fight on, because there's a concern. People would like to know what the regulators think, but there are rules about how you make it happen. And brokerage windows are, whether you love them or hate them, are very common, especially in a lot of large plans. And they are legal and allowed under ERISA. There's no law that says what you do, and they are not designated investment alternatives. So where we stand today is we have an increasingly dug in, it's almost like trench warfare type of situation where the Department of Labor is saying, we can do this. You have some members of Congress saying, no, you can't. You have trade groups coming out saying, wait, how can you do this? Why? This is the wrong way to do this. And everybody's sort of staring at each other. And will someone blink? Will we reach some practical, workable solution that fits in the legal framework? Who knows? But for right now, this could impact a lot, because for those of you who like ESG, for those of you who like alts, those of you who like crypto, the real question that's coming up is, each time there's a change in administration, how easy is it to change the rules? For some areas, maybe it's not so hard, but in the land of benefits, shifting investments around and shifting design, our industry moves at the pace of a slug sometimes. Sometimes it's very fast, but sometimes there's just a lot that you have to do. So this is really the coming to a head of the fundamental question of how rigid is ERISA, how flexible is it, and more importantly, who defines that? Kevin,
Well,
I've gone all ethereal. Take me down.
Yeah, go on, Jeff.
No, I was going to say, just for context purposes, and just following, and Kevin, I apologize, I don't want to jump on you in this, but
Don't worry.
just want to throw this out there for you guys to kind of noodle on, is that to David's point, fighting this battle around self-directed brokerage, which represent less than 5% of assets in a plan. Okay, right? I mean, so this is something that these have been around for a long time. It doesn't garner a lot of assets. Doesn't mean that it won't, and that doesn't mean that it isn't a fiduciary responsibility. But Kevin, in your estimation, I mean, it just seems like, to David's point, you're fighting a battle on something that is really, in the context of a retirement plan, pretty minimal.
So Jeff, I think you're making an interesting point here, but I think it's kind of bigger than you're making it seem. I think when we look at how self-directed brokerage accounts are used, one of the things is they provide access to investment options around the plan lineup. And we look at, folks rolling out of retirement plans into IRAs. We look at economies of scale. And brokerage windows are typically, they're the steam valve of a plan investment lineup that allow, individuals who may want to go off plan menu to have a reason to stay in the plan while still having access to investment choices they want. We look at contribution rates to plans and we say, in 2022, we're worried that people aren't saving enough. And part of why they're not saving enough is because they may not have interests that align with their personal views, their personal goals. David highlighted it. There's that ping-ponging ESG guidance. Right now, if you go through a brokerage window, you can typically find access to ESG-friendly options. So it provides an incentive for those folks who want to save but want to make a difference in the world, however it is they do, to do so. So brokerage windows may be a small amount of assets, but they can really be a motivator in terms of allowing individuals to invest in plans or encourage them to invest in plans because of them access to the types of products they want. And here, if DOL is saying, and this is the concern, that you have an obligation to, monitor or limit things in brokerage windows to, what DOL or what someone views as prudent, it creates some real concerns. One is, they shouldn't be picking asset class winners and losers, and that's the second half of that piece. But let's not focus on that now. But let's look at things like ESG inside a brokerage window. You could look at the guidance that we have and then get worried that, if I'm allowing people to access ESG through a brokerage window, that, it could raise those same returns because I may be letting people take on more volatile investments. I may be letting people get to investments that, pay a tiny bit of an additional fee to screen that doesn't, get a little bit more risk adjusted return. Now, it could still get people to contribute more to the plan. And I think DOL needs to be careful here when they start picking winners and losers, or when they start denying retirement savers access to things that could increase contribution rates in plan and could also decrease the incentives to roll out of the plan. So I know it's a small thing, but having that on the horizon really provides a safety route. And this new guidance could chill plan fiduciaries from including brokerage windows, which is only 5% of the assets, but it's a big incentive for keeping folks in plan and contributing to plans.
Yeah. Well, David, he told me, and of course the audience, but just to come back here to kind of tie things off, if you're a plan sponsor or you're a service provider, I mean, what do you do? How do you react to this, knowing that there's pushback from the industry, associations, law firms around this? I mean, if you're continuing to offer a self-directed brokerage today, you know, what do you think about it? Is this now at the top of the discussion during committee meetings, along with information and data sharing and privacy that we often talk about?
Jeff, that's a great question. I think, first of all, this is still working its way through in a lot of ways. I think it is worth something discussing in the meetings, but taking precipitous action and jumping and saying, we're going to eliminate something, that almost falls into the trap that we're having right now, where people are saying, well, this guidance said ESG is bad, ESG is good. I think it's good to stop and think rationally, because this engagement that you're seeing by members of Congress, trade groups, the DOL, certainly if a plan wants to be engaged, they can, but they have a lot to do. So my perspective on it is be aware, be monitoring. We certainly are going to watch where the investigation landscape goes, because I think there's some real concern that people will be suddenly questioned on brokerage windows, and I think that could cause a further fury in this area. But for right now, I think the basic steps is watch, discuss, but don't do anything precipitous, because there's a lot of things being dealt with here in DC. And of course, to close us out, as part of our segment, we'll keep talking about this as we learn more.
Yeah. Well, gentlemen, thanks. Great conversation. Thanks, Kevin. Thanks, David. Happy Mother's Day to your significant others and also parents, etc. And we look forward to having you back on the program again very soon, gentlemen.
Thanks, Jeff. Thanks, listeners. Happy Mother's Day, everyone.
Happy Mother's Day. Bye.
Take care. Welcome back. We're going to close the show out with a look at markets. And it's not that this is not important. It is important, but we wanted to devote a little bit of time to this after you heard all the rest of the important issues. Joining me on the line to discuss the market a lot more, covering his program all week long, is the lead anchor for the TD Ameritrade Network. I'm talking about Mr. Oliver Rennick. Oliver, thanks for stopping by this morning.
What up, man?
Hey, how you doing?
How's it going?
It's going great. I wanted to let's start off with your reaction to the week in the markets, because I've been getting phone calls from friends of mine, and I'm not a soothsayer. I know I'm not an oracle. I know no idea what's going to happen, but people are concerned out there, just regular retail investors, when they see the market go up and down, and more down than up. What's your sense of what's going on?
It is good reason to be concerned. For listeners of your podcast, last week I was worried maybe I got a little bit too dark on your show, but I think it looks pretty appropriate in retrospect. There is good logic for why the market is doing what it's doing. There is not a one-time news event, geopolitical catalyst, or shock event that is causing volatility. When those things happen, there is a general good reason to buy dips and follow the trend, the long-term trend of markets higher when those types of sell-offs happen. That's not what's happening here. This is a market that is seeing major trend change and very real structural shift that is not just about COVID versus post-COVID. That's a really big part of it. But there is also a much longer-term issue with the bond market that is finally coming to some real fruition here. And that is a simple reversal of trend. Trends are your friend, is what technical analysts like to say. It is a simple technical principle that objects in motion stay in motion until acted on by an outside force. It's physics in markets that when there is a trend in a direction, you want to play that trend. And so we look at charts to figure out when the trend changes and when a new trend forms. Over the course of the last year, the 30-year trend of Treasury yields going downwards because of policy, demographics, and a few other important reasons is now turning around and going the opposite way. As that happens, there is going to be a big shift in how people apply their money. And so firstly, to look at the trend, this week the 10-year yield had an explosive move through 3%, a level that it had difficulty getting through when we spoke last week. It broke that barrier and is now the highest since 2018, when the Federal Reserve was last trying to hike rates. It's a really important context, because in 2018, the Fed stopped hiking rates for two reasons. One was the bond market inverting. Long-term yields went below short-term yields, and a classic recessional signal happened. But the economy was actually quite robust at the time. But Jerome Powell at the Federal Reserve, reason number two, was also getting harangued constantly by President Trump to cut interest rates. Whether or not the first or second reason was the one behind their decision to ultimately stop hiking rates and cut rates, it happened. And most explained it through the bond market. They said Jay Powell had to listen to the bond market's recessionary signals despite the robust economic data, and cut rates at a time that financial conditions were the most accommodative for a rate cut in history. When the Federal Reserve cut rates in 2019, it was the most accommodative economic backdrop, the loosest financial conditions as measured by the Chicago Financial Conditions Index for a cut ever. The reason why that's so important to think about that time is because the 10-year yield is now back to where it was then. But last time, that's exactly when it stopped. And it went right back down all the way through COVID. This time around, though, there is very little reason. There's, I would argue, no reason at all for the yield to be rejected from going higher. Because the economy is very strong on an employment basis, as we see right now. We have defeated the virus. There is economic growth potential to be unlocked. And most importantly, there is still very high elevated inflation that is going to require the Federal Reserve to hike 50 basis points next month, as they just did this week, and then probably some more after that. Now, if we do get the yield above that 2018 level, then the 10-year yield chart tells us that it could go for a very long ways, because the trend turns around. And once that yield trend turns around and continues to go higher, pretty much all the assumptions that have been behind the primary bull case for owning growth tech stocks over the last decade and a half start to unwind, as they have been for 6 months. So if the 10-year yield trends higher, then we should generally assume, based on the last 6 months, that the NASDAQ will trend lower and the dollar will probably trend higher until something changes. But it's very difficult to see what could change that right now. And that's why we are selling rallies, and bulls keep getting run over every time they try to push the market higher. And there's very little logic for why that will stop. None of this means that the economy is on the brink of a collapse. In fact, somewhat the opposite. Powell is confident because of the type of employment print we got on Friday. So it's going to be a very, very difficult environment for people who are tied to the overall stock market index, but it may not be so bad an environment, and probably a much better one for real life living Americans in the post-COVID world.
And you say, I like how you break it down for real life Americans, and that's what we're talking about here on this program. Institutional investors, very important, because they're trading pensions, endowments, foundations, family offices. That's very important. You're part of the TD Ameritrade network, Oliver. What's your sense for retail investors? Are people just like kind of shell shocked? Are you hearing from your colleagues on the brokerage side that there might be less trading volume? Has trading volume picked up as a result? People are very irrational. We're all irrational. We're all emotional. We make rash decisions if we hear negativity or positivity. Go buy this, go sell that. But any sense for what the market flow looks like during the week?
Sure. I have to be a little bit careful about what I say, because there is a separation between our network and the business side of the brokerage, but a lot of it is public news that I don't have to get into super specific detail for people to know what I'm discussing, but here's what I will say.
Sure.
Is that my job at a network on a trading platform and for active traders is to try and always take them through what I see as the path of least logical resistance in what is going to happen, to try and help them understand relationships, to avoid the deepest pitfalls of this type of market. That's what we've been doing for a year now, when at first I was very bearish in our coverage in April last year when the ARK fund peaked and yields first started making this move, that was going to apply pressure to the weakest parts of the market. That bearish coverage has intensified over the last 6 months as that weakness has moved towards the broad index and now taken down some of our giants in the stock market. The reason why I start there in answering that question is because you can look to see how retail traders are doing, and at this point, it is purely a function basically of risk and leverage. If someone has been taking outside risk in the things that I've tried to identify as being highly risky for quite some time, crypto, companies that don't make money, businesses that have a plan but not profits, ideas that are stories and promises but not profits. These are the riskiest parts of the market, and why some traders who had an incredible couple of years could lose it all very fast. And we're already seeing that as areas and brokers that are at risk of high speculative trading clients, those are going to see volumes drop dramatically, and they already are. I'm not saying anything really new here. All of this is already out there. It's been well documented that there is some real suffering happening. I'm trying to do our best. We're trying to do our best to keep people from overexposing themselves to the assets that clearly have been sending signs even before the turning point came that this is the relationship that would hold. We try and identify relationships. I have no bias or really care about the fundamentals of stuff or what I think should be or what is good or what is bad. What we try and do is identify relationships so that if something happens, you should know then this other thing will happen. If we get yields continuing to go higher and the dollar rallying and the Fed hiking rates and the employment situation stable and no economic rollover, then crypto, high-risk stocks, and growth businesses are likely to continue sinking in valuation because historically they are still much too high, and we've now learned that the market is no longer willing to pay for companies that are not profitable. That means that it's not just the crypto stuff where there is still $1 trillion lingering, $20 billion, $15 billion in Dogecoin. These things literally have likely zero value, but there are stocks that matter to a much wider swath of traders and people who are now coming under similar pressure in the cloud space, in the tech space, in the electric vehicle space that do not make money, and the market is telling them they need to fast. And by the way, it's even now showing up in Under Armour, Shake Shack. Companies that are basic businesses that don't make money are coming under immense pressure.
Yeah, well, but Shake Shack, I'm surprised that they don't make money. I like Shake Shack. I got to say, the burgers there, Oliver, pretty good. When I lived in New York and worked in New York, that was a destination. All right, we got about a minute left. Take us into what we should be looking for next week, meaning Monday through Friday. I mean, what are things that, as you're building the shows, because you bookend the programming with your talented team of producers and writers, et cetera, but what are you looking at going into next week? Are there more earnings to be reported? Are you looking at any economic data that we should be, that will signal something?
Very difficult to know right now what type of fundamental news flow is going to really matter. Take Friday, for example, a very good employment report that we just got. Market is not rallying. It's trying to, but it's not. Right now, the best answer I have, there's inflation data you need to watch that is coming up. There are earnings. The cloud companies start reporting later on in the month. That's going to be really important. Mm-hmm. But what you need to watch is the charts. You have to watch the price action. Right now, when the market is in this state of volatility, the actual numbers that come out are much less important than the response to them. That's always the case really in markets. But right now in particular, you don't know, it's hard to know if a good employment report or a bad employment report is going to move the market in a certain way. Because if we're kind of stuck against the wall, then there's a lot of data that could still be a negative force for markets. Just think about Powell's FOMC this week. I was thinking the stock market was going to rally on the FOMC announcement because Powell would go hawkish and we'd say, okay, he's fighting inflation, and there'd be a relief rally. That's the way the market looked set up for. We did get that rally, but he was actually dovish. So it's an example of how right now you're generally just moving more based on price action. We got the rally no matter what the announcement was, and then it was destroyed the next day. So you need to watch anything tied to inflation, of course, is the most important thing. Anything that relates to crude oil news flow as WTI and gasoline prices are rising again, that's important for the inflation conversation. But mostly, got to watch the TD Ameritrade Network.
Yeah, I love that you got the pitch in there. Oliver Rennick, it is amazing. And the coverage, I will say, as a person not involved in the TD Ameritrade Network, independent, unbiased, and a great way to fill your day with interesting insights for some great people. Oliver Rennick, great to talk to you as always. Thanks so much for joining us. Enjoy your weekend. Have a great Mother's Day. And we'll talk to you again very soon, my friend.
Thanks a lot, Jeff.
Bye-bye. And that wraps up this episode of BRN Sunday. Have a topic of interest that you think we should talk to? Drop us a line. And don't forget, for all the latest security news and lifestyle, wellness, finance, tech, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives or check out our latest content? Check out our website. That's www.broadcastretirementnetwork.com, and our streaming partners like Amazon, Roku, Samsung, over 100 to choose from. We're back again tomorrow, this time for another edition of BRN AM with a very special guest. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.